In part 2 of the ECL for Trade Receivable series, we're tackling a tough topic. What can go wrong if you don't comply with the expected credit loss requirements? In other words, the risks and challenges of getting ECL wrong or ignoring it altogether. Let's begin with a simple scenario. Imagine a company has a pile of old receivables, customers who haven't paid for many months. Under Ind AS 109, such companies should have been recognizing expected losses on those. But perhaps the company thought, we've never done this before. Our old method was fine. Or maybe the company was hesitant to take a hit to earnings. Fast forward, those receivables turn out to be uncollectible. Now it has to write them off in one go. Suddenly, the quarterly results show a big loss. That's exactly the kind of surprise ECL is meant to avoid by phasing in the expected loss earlier. If you didn't follow the rules, you not only get a nasty shock on your books, but you also have to explain to your board and auditors why this wasn't addressed sooner. Now consider the compliance angle. Ind AS 109 is mandatory. If you skip ECL provisioning, you are essentially overstating your assets. Regulators notice these things. In fact, there have been cases in India where companies got called out for not making provisions. One case involved a company that had crores of rupees in receivables sitting uncollected for years. They admitted they didn't provide for it because the company was already in the red and they didn't want to deepen the loss. Understandable sentiment perhaps, but not acceptable accounting. Regulators stepped in and said, "No, you can't do that. You violated Ind AS 109. Imagine being that CFO or director having to justify why you ignored a clear requirement. The reputational fallout can be severe. It signals poor governance. So, what makes ECL challenging? Why do companies struggle? A big part of it is that it's new and complex. You need to make a lot of judgments. What's the probability a customer will default? If the economy slows down 6 months from now, how will that affect collections? These aren't easy questions. Many finance teams are not used to injecting this kind of forward-looking analysis into accounting estimates. It often requires statistical models or at least a lot of historical data analysis. Some companies don't have good historical records of credit losses, or their systems can't churn out the reports they need. This is what we call a data challenge. If your data on past due receivables and write-offs isn't great, you'll have trouble building a reliable ECL model. Another challenge is segmentation. The standard expects you to group receivables by common risk traits, perhaps by industry, region, or customer type, and then apply different loss rates. Think about a company that sells to both government entities and small private distributors. The risk profiles are very different. A one-size-fits-all provision rate won't cut it, but breaking down and analyzing each segment means more work, more complexity. Now let's talk about the risks if you get this wrong. First and foremost, your financial statements could be misleading. If you underprovide for credit losses, you're effectively painting a rosier picture than reality. Users of the financial statements, whether that's investors, banks, or your own board, might be making decisions on false assumptions. And once the truth comes out, say in the form of big write-offs later, it could damage trust. For listed companies, this could even hit share prices because nobody likes earnings surprises, especially negative ones that hint at internal issues. Secondly, there's the regulatory risk. We touched on regulators examining cases. Additionally, your auditors will be compelled to take a stand. Under the auditing standards, if they find that management isn't booking adequate ECL, they might insist on an adjustment. If management refuses, the auditors could issue a qualified opinion. That's a scarlet letter on your annual report no one wants to see. It can trigger all sorts of follow-up actions, from shareholder questions to regulatory inquiries. And remember, NFRA is watching auditors closely on how they vet ECL calculations, so auditors themselves are very alert on this point. If you present an ECL number that seems unjustifiably low, expect auditors to ask a lot of questions. Another risk, which might not be immediately obvious, is internal. If your company isn't properly assessing credit risk, you might continue extending credit to customers who won't pay. It's like flying blind. Good ECL practices often shine a light on which customers or segments are riskier. Without that, sales teams and finance might keep doing business as usual, only to face larger losses down the lines. In a sense, not doing ECL is like ignoring your credit risk radar. Finally, let's acknowledge the effort it takes to comply. Yes, it's challenging. Companies have to invest in better processes, maybe new software, training their teams, possibly bringing in experts, all that can be daunting. But the cost of non-compliance can be far higher, whether through regulatory penalties or the hit to your company's value and credibility when a bunch of bad debts sneaks up on you. To summarize this segment, the pain of doing ECL is far less than the pain of not doing it. Non-compliance can burn you in multiple ways. As finance professionals, it's our job to navigate these complexities, not ignore them. The good news is that there are ways to overcome these challenges through best practices and even automation.